everyone. I welcome you all to this Tuesday debate here at DD. Today we are going to have a debate about algo trading versus discretionary trading, and we will be having two teams. The marketing team has Deep Roy and Rutuja Kamble, and the sales team has Akib Dare and Huzefa.
So the question number one is which trading method is more scalable and required less resources? And you all know the answer. It is discretionary method, algo trade, discretionary trading. Oh, Josefa, can you just
Yeah. So, as well said by Akib, and starting with the debate, the first question which we have is which trading method is more scalable and required less resources? So, at the first glance, algorithm trading looks more scalable. You write a code once and it runs across the thousands of stocks in different time zones and multiple markets without needing a coffee break or sleep. That's why firms like Renaissance Technologies manage billions with relatively small terms. The mechanisms appears to be doing the heavy lift, but that's not the actual picture. If you see the other side, the scalability comes with the hidden cost. Scaling an algorithm means scaling risk. It is a model is fall over and the assumptions break. They did it in the COVID-19 crash of 2020. The losses are multiplied instantly across all market. Algo the algo is touching. So here would like to give you more brief about the context that as people imagine that what algorithm is just a code which is running and doing things automatically, but that's not the reality. The reality is that there is a lot more database work, mechanism work, lot many developers, lot many costs are invested. An organization is built at the back, years of research is being done, then an algorithm is made. But after that, of hundred of back testings, multiple breakdowns, hundred of bugs which comes across in that process, still few of the organizations and few of the algorithms has succeeded to make a big difference in the market. But where we compare it to the discretionary trading method, there is only an individual trader, a human being who uses his brains, his resources, his news, his instinct, his knowledge, and accordingly take the decision in the market what he has to do. Based on his intent, he works for and takes the trade. So here are some of the great examples in front of us about the discretionary trading. Discretionary trading is often dismissed as in not scalable because it relies on human judgment. But the judgment is the very reason of discretionary trading can scale more sustainably. You don't need to cover every market to be effective. You focus resources where the judgment adds the most value. Instead of chasing thousands of trades blindly, discretionary traders scales through selectivity by building conviction in the favor but smarter positions. Here we are trying to explain that for making money, ultimately everybody is here in the stock market. The ultimate achievement is to create the value and worth. So rather running algorithms across 100 markets, taking multiple trades around is not the ultimate purpose. If you really want to create value, you have to focus on those resources which you have, and accordingly take the decisions.
No doubt, without any doubt, algo trading strategy is more scalable and requires less resources. Multiple sources and it has been actually confirmed through multiple sources, through quantitative research data on algo trading, as well as factors driving scalability. Let's dive deep into this. For instance, SEBI reported that algo trading accounted for 97% of foreign investors and 96% of proprietary traders' profits in futures and options in 2024. SEBI also is encouraging retail investors to participate in algo trading, a sign that algos are becoming more scalable. And in terms of market dominance, the IMF's Global Financial Stability Report says that in US, algo trading now constitutes about 70% of equities trading, more than half of futures trading. And also robo-advisor firms, those that use algo trading, their projected growth is from 10.8 billion USD to 69.32 billion USD in 2032 with a CAGR of 32%. And not only that, it's not restricted to retail investors. Proprietary trading firms also come into picture, wherein Hudson River Trading, they have also reported a net trading revenue of 8 billion USD in 2024. Of scalability, for instance, if it's coded once, one algo strategy can be deployed across multiple markets, equities, crypto, forex, and multiple accounts. Automation, of course, it enables massive scale, and also there is low marginal cost of scaling. Once it is deployed, then after coding and backtesting, each extra trade or portfolio adds near zero cost. So there is industry-wide adoption. As I have also already mentioned, robo-advisors, firms like Betterment, Wealthfront, they are actually deploying algo trading. Also, FTMO, that's a proprietary trading firm, they have reported over 2.3 million trading accounts in 2024. That's a 33% year-over-year increase. Okay, and the size was only 13 million USD in the previous year. And also in terms of human resources, it actually needs a lot less. Now, a study was conducted. This is the quantitative evidence that actually a study was conducted and published in the hedge fund journal Systematic versus Discretionary Trading, wherein it was concluded that discretionary managers require many years of track record before their skill can be statistically validated. With a sharp ratio of 0.7 over 8 years, which means 8 years are needed.
Scalability is the whole different thing that you are talking about, and resources that is needed for scalability is another part. So you have to struggle with scalability and resources to maintain your scalability and algorithm and all. But if algorithmic trading is more scalable, why does it demand supercomputers? And
Okay. Hmm.
does it work in low latency network or not? How can you say like it is just scalable and all? What are the parameters of it?
Your
And
point is over? Hmm.
here if you look on our side,
Hmm.
our heart is human brain.
Hmm.
That's all we have.
Yep.
Based on your research, which you
Hmm.
you can just explain, based on the counters which you have received by Akib, Shrikant, and me. Based on your research, you just gave your figures, reports, research, and analysis how the study has been done. But the basic questions which was asked and was being debated was the resources, which was not highlighted in your research, I believe.
All algo trading, I will again counter. Algo trading is way more scalable in terms of everything, in terms of lot of aspects, in terms of coding, in terms of time efficiency, in terms of productivity, is in terms of risk management. Now, coming to the resources aspect as well, human capital. You said about human capital. Human capital, it requires way more compared to discretionary trading. In terms of time, time is also a very important resource. And compared to discretionary trading, time required is way lesser. Reason being, it's automated. It's very obvious. Coming to the operational risk also. Again, there is a lot of risk involved, and risk managing. Let's say, for instance, you're a retail investor and you are into discretionary trading. There are a lot of risk. I mean, if you fall sick, and then it goes down, means you can't even trade. And in terms of proprietary traders, or let's say institutional investors, with each added benefit, they have to add manpower. Whereas in algo trading, you don't have to add manpower because it's all coded, it's automated. So the resources point is highlighted very well in my research. And the last point, what I will say in terms of technology and infrastructure. In terms of technology and infrastructure, which you highlighted, on the onset, algo trading might require a bit of setup. Technological infrastructure might cost a bit more, but the ongoing cost is way, way lesser, as it has been proven through quantitative evidence that I highlighted. That is the reason I highlighted the quantitative evidence that concluded that the resources required in algo trading, ongoing resources, is way lesser compared to discretionary trading.
Which trading method is more stressful? Here, in the case algorithm trading, once code is written, the system runs automatically, executing trade faster than a human can. May argue that since the mechanism makes the calls, the trader avoids the emotional roller coaster of fear and greed. But in reality, stress doesn't disappears at all. Is just gets shifted. Algorithmic trading faces content fear of constant fear of technology failures like execution errors, bugs, server outrage, fat finger inputs. These are some term, big terms which comes across the algorithms and which leads to big losses. Here we have a study and a great example how to lose 440 million in 45 minutes. One of the US based trading organization King Knight Capital on 1st of August 2012, which has deployed a faulty trading software and in 45 minutes, less than an hour. As the great speaker has also given their insights that how the stress is information for them based on their experience and investment in the market, right? And as they well said by Stanley Backmiller, that the best trade are the ones you don't make. One of the greatest examples about the intentions based upon the research that John Miller in the year in 1987, when everything was going good, everybody was buying, everybody was in the good bull run, right? He got an intuition that things are not as it should be. He exactly in 1929 the same scenario has been happening. He got that intuitions. Based on that, he changed his position. He said at the sell side, and accordingly he made his portfolio go over by 200%. Stress movement is there where the other was in a bull run, and he accordingly based on the sensation good run, nobody gets that stress, nobody gets that intuition that the fall will come, but he got it. As he was a discretionary trader, he knows how charts go, how situations happening. If everything is going good, there is something fishy around. Accordingly, he made the decision and changed his position, which lead him to a scalability of 200%.
Now the next topic is which method is more stressful. मैनुअल ट्रेडिंग काफ़ी ज़्यादा स्ट्रेसफुल है एज कम्पेयर टू अल्गो ट्रेडिंग। उदाहरण के लिए रोबोट एडवाइजर जैसे बेटरमेंट और वेल फ्रेंड जैसी कंपनी जो अल्गो ट्रेडिंग मेथड यूज़ करती है, वो अपने क्लाइंट को सर्व करने के लिए और बहुत सारे प्रोसेस को ऑटोमेट कर देती है। अल्गो ट्रेडिंग के जरिए जैसे एसेट एलोकेशन, पोर्टफोलियो रीबैलेंसिंग और टैक्स लॉस हार्वेस्टिंग, इससे क्या होता है कि बहुत सारी जो चॉइसेस जो एक ट्रेडर को करनी पड़ती है वो सब ऑटोमेट हो जाती है। इससे चॉइस रिलेटेड और टाइम रिलेटेड स्ट्रेस कम हो जाता है। और एग्जांपल के तौर पे बेटरमेंट कहता है कि क्लाइंट कभी कभार ही लॉग इन करता है और इम्पल्सिव ट्रेडिंग भी नहीं करता क्योंकि सब कुछ ऑटोमेटेड है। एमआईटी ने डे ट्रेडर्स पे स्टडी किया है। ये स्टडीज वैलिडेट करती है कि मैनुअल ट्रेडिंग बहुत ज़्यादा स्ट्रेसफुल कंपेयर टू अल्गो ट्रेडिंग। रिसर्च ने 3 पैरामीटर्स पर ट्रेडर को स्टडी किया है। पहला, डे ट्रेडर्स का रिस्पॉन्स वोलेटाइल मार्केट में। दूसरा, इमोशनल रिएक्शन का इफेक्ट ट्रेडिंग परफॉर्मेंस पे। और तीसरा, पेपर ट्रेडिंग और रियल ट्रेडिंग का कंपैरिजन। इसके कारण उनका हार्ट रेट और स्किन कंडक्टेंस भी इंक्रीज होता है। इमोशन जैसे फियर या ग्रीड अक्सर क्रिटिकल डिसीजन मेकिंग को इम्पेयर करते हैं, जिससे पुअर ट्रेडिंग आउटकम्स होते हैं। कभी कभी स्ट्रेस इतना हाई लेवल हो जाता है कि लॉजिकल रीजनिंग फेल हो जाता है और ट्रेडर्स को ट्रेडिंग छोड़ना पड़ता है। पेपर ट्रेडिंग वर्सेस रियल ट्रेडिंग के बीच यह पाया गया है कि पेपर ट्रेडिंग करने वाले भी सिग्निफिकेंट इमोशनल स्ट्रेस फेस करते हैं। तो इससे ये पता चलता है कि मैनुअल ट्रेडिंग काफ़ी स्ट्रेसफुल है एज कम्पेयर टू एल्गो ट्रेडिंग।
If you have invested your money out of the pocket, you have that human intention, although things are being automated, but you have that feeling inside you to watch what happened today in the market, right? You end up being in the profitable position or you end up being in the loss. And we don't, I, it's not the, it's not that every algorithm is working 100% in a profit. There are days which algorithm makes profit, there are days which algorithm make losses. Some algorithms, that's the reality of the market. Same goes for the discretionary trader. So this statement of saying that it's completely stressless, completely human free, once you plug and play it, it's not the reality that you do just plug and play. It can be a good pitch line or good tagline for the companies who are selling algorithms, but as in consumer point of view, as in trader point of view, it's not the reality. You have to watch the market. You have to see what happened at the end of the market.
Like for instance, I don't know whether you have heard of the firms Betterment and Wealthfront. They are very well-known firms in the US, actually robo-advisor firms, and we have given you some data also, okay, and it is completely validated. I mean, in no way they can grow if the retail investors won't adopt them, right? First of all, second is you are talking about it's not only plug and play. I am just keeping aside the marketing aspect of the firms. Okay, I am talking about in terms of constant monitoring. That is actually you need to do in discretionary trading or manual trading.
Second question is that there yesterday market was, say for example, Nifty was reading around 24,000. Suddenly there is a bad news globally and the market opens itself at, say for example, 400 points down. These algos will not be able to work at that time.
See, first of all, we are talking about stress. We're not talking about any particular instance. We are talking about which method is more stressful. We are actually deviating from this point.
So
What I understand.
adding to Srikant sir's point, what sir meant to say that if your algorithm after this kind of situations break, the person who has thinking in that imagination or delusion that things are going automatically, but the algorithm got broke, and he's not aware of why, because he's not watching the market, he's not getting aware of what is happening later on after pass of the session or after the things has gone out of his control or against his favor at all, he ended up making a huge loss. Which trading method handles market volatility better? Here the actual picture comes up based on the manual trading and the algorithm which we are just talking about in this debate. Human can adapt the real-time interpreting news, sentiments, and sudden spikes far beyond what were pre-programmed rules can capture. Algorithm often struggled in extreme volatility. They may trigger unnecessary stop loss or execute trade based on outdated parameters. A skilled discretionary trader can pause, reasons and act with the context, whereas an algo trader follow the rules blindly or has to be shut off. Algorithm makes trades, humans makes decisions. If we have a great example as in COVID-19 crash in March 2020. In COVID-19 crash of March 2020, the global market collapsed by over 30%. Algorithms sold blindly into panic, while the discretionary traders used this judgment to see it's the recovery before it is happened. So here would like to just give you more point that in that crash, algorithm went by the flow that things gonna go negative, negative, negative as everything was going negative around. The bloodbath was going around in the market. Whereas as in discretionary traders, for them it was the best opportunity to invest and accordingly to be into the position so that once things get settled down, they're gonna be having good returns. And if we don't have the numbers at present. If you see in that duration only, the numbers of traders has been spike up as per the research and the resources of the SEBI. Numbers of demat account got increases, number of brokers got increases after this uh, COVID-19 crash, where in 2011, when the sudden extreme dropped over there in the US stock market, almost 1,000 points in a minute before rebounding algorithm triggered an ample amount of hands restored ordered. So the demonetization has been all known that all of a sudden in the evening, our prime minister came up and announced that the the 500 and 1,000 rupees notes were banned, and accordingly, algorithm was not able to digest that, was not able to figure that how they gonna shift their positions, how they gonna react in the market. But as a manual trader, as a discretionary traders, they were very smart. Accordingly, they switch with their portfolios. They started investing into those segment which were more connected to e-transfer, net banking, and all kind of segments, whereas they square off their positions in the real estate jewelries, which suffered a heavy loss. Russia and Ukraine war, another similar examples, that algorithm was not able to adapt this news, was not able to predict what gonna happen, how gonna things work, because algorithm is not tuned in that manner. It doesn't have that features to read news, to analyze based on the news what is happening around the world, and accordingly predict and take decision. Is basically based on the database, based on the rules, the algorithm which is being programmed in it.
Of course, algo trading manages or handles market volatility much better compared to discretionary trading. And multiple sources like studies from multiple sources like NASDAQ, OMX, then India Equity Market, NSE data, and then 2010 flash crash, as you already mentioned. Thanks for that. So, how they did it? Of course, the algo trading shut off automatically, while, whereas discretionary traders froze, worsening losses. And of course, the academic report also published in the Journal of Banking and Finance. This was a study on retail investors during COVID-19, and the graph shows it is the graph that relates to the market liquidity crisis. And towards the right of the graph, as we see that there is a plunge, and it dips actually during the month of April. The study validated algo traders remained active, resilient, and more consistent. Even for institutional investors, there was a study by Bank of International Settlements, and it was on foreign exchange liquidity conditions during COVID-19. And on the left side of the graph, it shows spread versus volatility, Euro, USD, JPY pair, and GBP and USD pair dispersion on the right side. And it concluded that despite heightened volatility, algorithms maintain significant volumes and two-way order flow. And this is the monthly performance by algorithm style across metrics: performance versus risk transfer, market impact, actual versus expected cost. And it concluded again that algos outperformed risk transfer and showed lower slippage, reduced market impact. These graphs are important. These graphs are quantitative evidences, not statements. Quantitative evidences that showed that during COVID-19 volatility, algorithms scaled up, filled more quickly, delivered better execution than traditional risk transfer execution, and also highlighted that institutions using this algo trading strategies manage trade-offs. Again, there was a study on proprietary algo traders, and again, they came with the same conclusion. It also showed that proprietary algo traders increased buy and sell depth during extreme returns, thereby restoring the liquidity after shocks.
So overall, you are working on the rigid rules, but volatility offer like it requires intuition, and judgment. So, like how your system account uh, captures or the market signals that has no valid data and historical things.
Because algos are backed by data, historical data. It's these are all data driven. It's not a pseudoscience. So that's a very wrong phrase to use in the
Uh,
first place. Second thing is all these are quantitative evidences that I have shared. It is not something that came out of my mind, and these are regulatory reports. So it already validated that actually it is not, in general, all algos are driven by data. Okay. Some less sophisticated, some more sophisticated. That is the only difference. Okay. So, of course, it's automated and data driven. That's why it can actually, and also capable of controlling risks. So all this equipped together, it actually equips a retail investor or any category of investor, as I have already shared through my data, that the quantitative data speaks in terms of volatility, in terms of any condition, whether it's a normal condition or extreme condition.
so our next question is which trading method makes better decision?
Like history's biggest traders where discretionary comes. So based on the research and the analysis report, George Soros in 1992 sh- shorted the pound and made a profit of 1 billion. So in the real world, as we already discussed about the Russia and Ukraine war, so in in ample amount of situations, algorithm is not able to take that whole of a sudden sharp move. If you talk about volatility, accordingly things gonna work. But what about the point when the news comes into the market, when the market start reacting immediately? It doesn't wait for algorithm to tune themselves. It doesn't wait for the algorithm to change their strategies or parameters. Accordingly the market react. All right, so that's about us. That about the last question, that making decisions is more far easier and quicker based on the news, based on the things happening in the world, as compared to algorithm. Algorithm need to be retuned, need to be reconfigured based on the situations, and accordingly they're gonna happen. Whereas as compared to a human being who is a manual trader, who can act on things immediately as it's come to his mind, right? So decision making is far more quick, far more effective, far more best performing, with the great examples in the manual trading. Whereas compared to algorithms, if you have made a decision, if you did things in a certain directions which is not in your favor, which can give you a big loss in just fractions of minutes, not even hours. So we have a great example of 45 minutes which made you a loss of 440 minutes, right? So these are the examples which we given you based on the research. And that's it from our end about the decision making.
Algo trading makes better decisions compared to discretionary trading. Decisions in terms of price discovery. So in forex markets, for example, manual traders' contribution fell from 30% to from 2008 to near zero in 2016, while algorithms rose to almost 100% of price discovery. Also, algorithms, related to superior decision speed. It can incorporate new information and update orders in milliseconds, outpacing the speed that the discretionary traders can take. So, because discretionary traders rely on a slower cognitive and execution processes. Also, algo is better in routine and high frequency contexts as well. And in terms of it is very much validated by the data that algo trading is actually dominant and is consistent across asset classes. So Bank of International Settlement data shows algos contribute the majority of price discovery in equities, foreign exchange, and futures, leaving discretionary traders with a minor role. Order placement efficiency, in terms of order placement also, it actually is algo trading is much way superior because it optimizes order size, timing, and venue selection. Now, this is a study and it was reported in Federal Reserve, wherein it shows how manual traders' contribution to price discovery collapsed to near zero, while algos became dominant in foreign exchange market. Hesitation perspective, wherein algos remove hesitation and second guessing, leading to more rational execution based on predefined strategies compared to humans. So this is a data based on the release from Zetra exchange that flags which orders come from algos and non-algos. The last one, that is, algo traders rely heavily on limit orders, as we all know, especially those placed at the best bid, right? So they rarely use market orders, but human traders, in contrast, use more market orders. So what does it show? This highlights actually algos are much more disciplined, rule based, and also it reduces emotional overreaction and hesitation. So decision making is way better by algo trading methods compared to discretionary trading.
So if algo like trading make orders cancel fast and it is more speeder than the human decision, then how can a glitch can cause 45 minutes glitch can cause 440 million loss? Why do not where is the like the break that you were saying, the guidelines and rules?
So first of all, those are some rare instances that you mentioned.
No,
Okay,
but
and
that is rare. I know
number
that is
one,
rare, but it
oh,
is there. You can't
adding to
defend
that,
on that. Yes.
it is not about the integrity of algo trading or inherently how the algo trading works. It was much more specific to the algo trading platform or the architecture in essence. What I mean to say is, algo trading is not something that there will be a glitch in the system and you can incur a lot of losses. It
Oh,
was one of an instance that there was a architecture failure, the technological failure, and it incurred losses. But what I shared with you, it is not one of an instance or nothing like that. Any special event I didn't share with you. What I shared with you, sir, some common instances. Based on that data, we have concluded that actually it manages or makes much better decision than discretionary trading. So exceptions can be always there in any case, in any method, but exceptions actually don't prove our point. You understand what I am saying, right? I haven't shared exceptions. I have shared common events, and common events point to one and the only thing, and that is algo trading makes way more better decision than discretionary trading, and it's proven by the quantitative data that I have shared. That's all I can say.
The marketing team favoring algos got 146 points, and the sales team favoring manual trading got 94 points. But it was a closely, I mean, don't, if we just walk away from the points for a moment, I think it was a very well thought out debate. Both sides presented excellent points.